Hey, this is Danielle. Welcome to the free video. So, I wanted to bring up Google today because I know that a lot of traders have been looking at Amazon and also looking at Google for a potential rally into and then after their various splits. When you are looking at, the past splits that have occurred over the course of the past couple of years, and that's why, of course, everyone was looking to these names. We had Nvidia. This was a great one, just massive rally into the split. It did end up falling once you actually got down to the split date, but major rally beforehand. Then you had Tesla, really nice rally into the split. Then you also had Apple. So I know that, these moves are fresh in everyone's mind. And I've told people so many times that if Amazon ever announced a split, I was going to go like balls to the wall long. But the problem here is that the split announcement occurred in the middle of a bear market. And so this is kind of an untested theory at this juncture because the regular pattern and regular setup that we were trading has now changed. So, when you are looking at what we can do here, I just want to start off by saying I don't know if this is going to work in a bear market. I really don't. Works in a bull market, worked before. It was a great setup previously. I don't know that it's going to work in this market condition, but I still think it's worth a shot. Just not at all in the balls to the wall kind of way, but a, very risk defined, controlled manner. So, when you're looking at Amazon, I did go ahead and put a trade on this one today. I know that it's already rallied going into the split, but typically you're going to see it rally post split for, a week or so. I will say that it is extended. The new split adjusted price is going to be, shows it trading at around to 125, right? So you've already made the 1272 extension. You've already made the 1618. If it does keep going, your next target is going to be up here at 135, and that would put you in line for about a $10 move into the monthly expiration series. Now, because Amazon just split, there's a lot of volume in the options, but you're not seeing as much open interest, just probably because these are new contracts. But I actually did myself try to put on a trade earlier today targeting 135, and it took a little bit to fill, but it filled just fine. So I was a little bit worried about it not having enough liquidity, but it worked out just fine. So this is the trade that I'm looking at for Amazon post split. Now that it's already split, it's going to be 125, 135, and then 145. So with a debit being paid of only $2.42 with $10 wide on each side, it's going to give you a little bit better than a 1 to 3 risk reward situation, which really, for me, with 11 days on a swing trade, you're just right about at the money. That's a pretty decent risk reward ratio. Now, you could widen it out a little bit more, mainly because of the market that we're in, because it's a little bit stagnant. If Amazon does not move for 11 days, which seems completely crazy, but now it's summertime, then you would want to make your butterfly wider. So that would ensure that if the market's a little bit stagnant, you're not going to die a death of theta decay with that initial long call as quickly as you would with an at the money fly. So I do like that trade. Now, the other trade that I wanted to look at was going to be Google. So Google has these really nice round numbers and everything seems to be pretty aligned. Now, like I said, I don't know if we're going to see this bullish run, but we're going to try, especially because they missed earnings last quarter. They fell going into earnings last quarter. Previously, we were able to trade Google to the upside every single quarter. It was one of those pretty easy trades. At this point, I do think this is a little bit risky, but I still want to try it. So, small size. Now, when you're looking at Google, I can see that it has a pretty nice big round number up here at 2,500. Google's pretty notorious along with Amazon for trading at those big round numbers. And right here, that's going to be right at the 50 simple. So when you're looking at that and you're saying, okay, well, when could it possibly be up at 2,500? Let's look at our options chain. I mean, by the time it splits, I would suspect that it could make it up to that zone. It has a $232 expected move. It's the July monthly series. It's, you know, going to be a series in which you're going to have more open interest. Right now, the options are pretty thin, so it's not really something I can put on just right in this very moment, just because you can see that the bid is 43 and the ask is 46.30. When you have a bid ask that's wider than $1, it really makes it difficult for you to get a good price on a butterfly. I can try to price it out and just show you what it would look like. But what my idea is with this is I just want to wait until we get a little bit closer. And then once we get a little bit closer, probably going to be able to put on a trade that is going to have a tighter spread. Now, you see I'm pricing this out, 24.50, 2,500, 25.50. Also, the market's closed right now, so that might have a little bit of an impact. You might want to check it again tomorrow. But you see how the mid price is 335 and the naturals 990? That means the spread is way too wide. That means if you're not careful and you don't hit your little lock button, you could be bidding for an entry at 335 and literally get filled at 990. That is going to significantly skew your risk to reward and give you, you know, the worst price overall. Don't want to do that. So that's why you want to lock it near the lower end of the range. But more importantly, just don't even do it until the spreads come together closer. You really want to see the spreads like $2, if that. And right here, sitting at $6, a little bit more than $6, it's just way too much. So I like the trade. I like the idea. I want the spreads to come together a little bit more. If you did it $100 wide, the spreads are still going to be about $6 wide, but you also have a $100 wide butterfly. So you have a far larger range that you're working with. So it's not, you know, as bad. The reason why big spreads, wide spreads can be bad is because you don't want to get in paying, you know, the highest price, and then when you get out, sell it for the lowest price. That's how you just cause yourself to lose money for no good reason. So that is all that I have for you here tonight. I'm going to be teaching a class this week, so if you want to join me for that, it's going to be a whole lot of fun. I can post the link. It's called simplertrading.com/diamond, which is where you want to go ahead and get to your link right here. I'm teaching a class called Diamonds in the Rough. It is going to be about how to identify relative strength and weakness and go with the flow of this crazy market. I'm also specifically going to be focused on butterflies. And if you want to join me, we have live trading on Wednesday and Thursday from 1 to 3. So hope you have a great rest of your day, and I will see you next time.
Hey traders, it's Danielle here with Simpler Trading. Thanks for watching. If you enjoyed this video, be sure to like and comment down below. Also, be sure to subscribe and click the bell icon so you will never miss the latest take from our trading experts. Did you know that we provide real-time trade alerts so that you know exactly what we're doing, exactly when we're doing it? Go to www.simplertrading.com to learn more. Good trading, and we'll see you in the next video.